A 28-year-old in America walks into a dealership just to look around and leaves with a brand new car and a monthly payment that quietly controls the next 6 years of his life. At first, it feels like success. The new car smell, the smooth drive, the upgraded interior, the feeling of finally making it in life. But what most people don't realize is that in the United States, the car itself is often not the real product being sold. The real product is a loan, and that loan is one of the biggest reasons millions of Americans stay financially stuck even when they have decent salaries. Because in today's America, owning a car is not just about transportation anymore. It has become a status symbol, a lifestyle statement, and for many young adults, an emotional decision rather than a financial one. And that's exactly where the trap begins. Most people don't walk into a dealership thinking about long-term wealth. They walk in thinking about monthly payments. That one shift in thinking changes everything. Instead of asking, how much does this car cost? The conversation becomes, how much can I afford per month? And that's where things get dangerous. Because when the focus is monthly payment instead of total price, the dealership can stretch the loan longer, adjust interest rates, and add hidden costs in a way that makes an expensive car feel affordable. A car that should have been financially out of reach suddenly feels easy to own. And that feeling is powerful. In cities like Houston, Atlanta, and Los Angeles, it's extremely common to see young professionals earning solid incomes, driving cars that look successful from the outside, but are actually tied to long-term debt on the inside. One real example comes from a 26-year-old in Texas who upgraded his car 3 times in 5 years. Each time, he rolled the remaining loan into a new one, thinking he was improving his lifestyle. On paper, it looked like progress. In reality, his debt kept growing. By the time he realized it, he was paying for a car he didn't even own anymore in any meaningful sense. The monthly payment had become a fixed part of his life. Like rent, like taxes, like bills he couldn't escape without serious financial damage. And this is not rare, it's normal. Because in the US, the average new car payment has quietly climbed to a level where many people are spending hundreds of dollars every month just to maintain a vehicle they technically don't fully own yet. The psychological trick is simple but powerful. A small monthly number feels manageable. $450 per month sounds fine. $550 per month sounds acceptable. Even $700 per month feels justified when you're sitting inside a shiny new car. But what most people don't calculate is what that money becomes over time. That $550 per month turns into thousands per year. Over 5 or 6 years, it becomes a massive financial commitment. And by the time the loan is paid off, the car has already lost a huge portion of its value. So people are not building assets, they are paying for depreciation. And depreciation is silent, you don't feel it monthly. You only realize it years later when you try to sell or trade the car. At that point, the financial gap is already gone. Another hidden issue is that car loans often stretch longer than people expect. 6 years, sometimes even 7 years, which means people are stuck in payments for almost a decade of their financial life cycle if they keep upgrading. And upgrading is exactly what the system encourages. Because once someone gets used to a certain lifestyle level, it becomes psychologically hard to go backwards. Even if they want to reduce expenses later, the idea of driving a cheaper car feels like failure instead of smart financial recovery. That emotional pressure keeps people locked in the cycle. The car industry understands this very well. Everything in the buying experience is designed to shift attention away from total cost and toward comfort, features, and monthly affordability. The test drive feels smooth, the interior feels premium, the sales conversation feels reassuring, and by the time paperwork comes out, the decision is already emotionally made. That's why so many Americans sign car loans they didn't fully think through. Because the decision didn't happen on paper, it happened emotionally inside the car. Even digital platforms now reinforce this mindset. Online calculators show estimated monthly payments instead of real total cost impact. So people compare cars like they compare streaming subscriptions, not long-term financial commitments. And that comparison is misleading. A car is not a subscription. It's a depreciating asset tied to insurance, maintenance, taxes, and interest. But when all those costs are broken into small monthly pieces, the full picture disappears. And when people cannot see the full picture, they cannot make fully informed decisions. That's why so many Americans end up financially stretched even with good salaries. Because their income is not just paying for their lifestyle, it is quietly locked into long-term obligations they signed years ago. There is also a deeper cultural factor. In the United States, cars are strongly tied to identity. For many young adults, the car they drive is part of how they are perceived socially and professionally. So when income increases, upgrading the car feels like a reward, not a risk. It feels like progress. But progress that is financed through debt is not real financial progress. It is delayed pressure. And that pressure always comes due eventually. There is also a common misunderstanding that refinancing or extending a loan is a financial solution. In reality, it often just resets the problem instead of solving it. Lower monthly payments can feel like relief, but they usually come with longer debt cycles or more total interest paid over time. So the system keeps people comfortable in the short term while increasing their total financial burden in the long term. And the most important thing to understand is this: car loans are not inherently bad. The problem is how they are used, how they are structured, and how emotionally driven the decision making becomes. Transportation is a necessity in most parts of America, but financial pressure from transportation is not. The difference comes from awareness. People who treat car buying as a financial decision first usually end up in control. People who treat it as an emotional upgrade usually end up stuck. The good news is that the cycle can be broken quickly once it is understood, because once someone sees how much money is actually being lost through monthly payments, interest, and depreciation combined, their entire perspective changes. And that awareness alone can prevent years of financial stress. A smarter approach is to shift focus away from monthly comfort and toward total financial impact. Instead of asking what feels affordable today, the better question is, what builds stability over the next 5 to 10 years? Because real financial freedom is not about having the newest car. It is about having options. Options to change jobs without pressure. Options to handle emergencies without stress. Options to invest instead of constantly paying interest. And every unnecessary car loan reduces those options quietly over time. The system does not feel like a trap in the moment. It feels normal, even exciting, but financial reality always shows up later, not during the purchase. And by the time most people realize it, they are already inside a long-term payment cycle they didn't fully understand at the start. That is why understanding car loans is not just about money. It is about control. Control over income, control over lifestyle, control over future decisions. Because once financial decisions start controlling your monthly life, freedom becomes limited even if the salary looks good on paper. And breaking that pattern is what actually separates financial stress from financial stability in modern America.